right, hey, welcome back, everybody, to today's Market Explained. This is the show where we talk about the financial markets and explain what's happening in normal, hopefully normal terms. I'm Brian Castle. I'm your host, and with me today is my co-host, Mr. Chris Reardon. Chris, welcome.
Thank you, Brian. Afternoon, everyone, and glad to be here. Glad to talk a little bit about the markets and what's going on out there.
All right, and everybody, if you're new to our podcast, Chris is our Director of Development at our firm, FourStar Wealth, which is a national firm headquartered out of Chicago. Chris does everything with portfolios and development and marketing, and he leads the whole development team. So he's a very valuable guy to FourStar and very useful on our podcast as well. So again, Chris, glad to have you here.
Thank you, Brian.
And I'm the CEO and founder of the firm, and I'm also an advisor to corporate executives, CEOs, insiders, and others. Also work with one of the largest financial practices in the country. We have 43 advisors at FourStar, and I lead the group. And I'm also, most importantly, father to Evan and Quinn, and husband to the amazing Tripti. So that's our story. And if, by the way, you like what we have put on today, please give us a 5 out of 5 ranking and tell your friends about it and pass along a version of this. Save it as a favorite in your system, in your podcast, and also send a copy to your friends so we can see more and more viewers and listeners to this. And for those who are listening, this is all available also on YouTube, and you can see us taping this live right now. So anyway, so we're going to go through the markets. We're going to talk about what's happening in the financial markets. We're going to talk a little bit about the economy and then some things that we see out there that we think are important to know. Chris, so tell us, what is going on in the relationship between different asset classes in the market?
Yeah, Brian. So not a whole lot of change. I mean, we didn't see some major shifts, but we did see some slight movements. I'd say some reinforcements of trends we've seen kind of over the last couple weeks. Domestic equities continues to stay in the number 1 position. It gained 1 point to 260 tally points. So it certainly is kind of strengthening. It's obviously not gaining, large chunks, but it is consistently gaining, a handful of points, I would say, every couple weeks. So that's important. That's obviously, and that's strong. It shows there. International equities is holding tight in that number 2 position. It's at 246 tally points, and it's gained 3 points from the last podcast. So we're seeing that start to slowly pull away from commodities in that number 2 position. It's only about 9 points higher above it, but so it still stays within striking distance. But the more that continues, the more we see that trend, we continue to see it gain tally points, the more entrenched it becomes in that number 2 position. Commodities are the number 3 positions at 237 tally points. It lost 2 points from the last podcast. So we continue to see commodities on a broad basis continue to pull back. And we've talked about this on here. There are some commodities like gold, like silver, that are doing well, but on a broad basis, when you look at agriculture, energy, everything as a whole, the asset class is slowly moving down. Cash is in the 4th position, is at 130 equal, so no movement there from the last podcast. Currencies is in the 5th position at 119, -1 from the last podcast. And then last is still fixed income. It's -2 from the last podcast and at 97. So really below those top 2 asset classes. Everything else lost points on the week or on the between the last podcast. So but not a whole lot of change, as I said. I mean, the highest being 3-point movement, which was international equities. Not a whole lot of change, but as a reinforcement of domestic equities and international equities continuing to gain momentum, kind of coming into mid to late July now.
So, Chris, after our I like to call it a near-death experience after the Trump tariff collapse in April, and then it went into May, and then we started to rally back. We're back on offense. We're back on a risk-on market, aren't we? I mean, domestic equities, international equities, and commodities are basically at the same level, right? And so they're both about 200, and we've seen it where like domestic equities have been 300 score, way ahead, But right now, they're ahead, but not by much, right? So that's kind of it's a risk on market, but commodities could easily jump up there again just because we're sitting here, right? I mean, it's kind of hard to figure out, isn't it?
No, I mean 100%. And commodities, I would say are can be much more prone to quick movements like that. I mean, all it takes is, a geopolitical event in the Middle East or something like that that would disrupt oil. We could see that pop that commodities up, 10, 15 points and overtake international equities and start challenging domestic. So
Mhm.
there is, I'd say, within striking distance, those top three are really
Yeah.
changeable to a degree.
Hmm.
But the trend we've seen, at least so far, has been domestic and international continuing to slowly separate. If that trend does continue, maybe by the end of the year, towards the end, we could see that distance and actually have a decent gap between commodities and those top two. But for right now, commodities is still kind of hanging in there, although it has been weakening, I would say, the last couple months.
It's been weakening a little bit. Precious metals have still been strong, but some of the other
Mhm.
commodities are weak. The other really interesting story in this bifurcated market where there's three major asset classes that are all kind of like right in line with one a little bit ahead and the second, and they're all kind of right near each other, is international continues to stay up. Now we've had 17 years of underperformance for the international markets, but now we're seeing international actually work. And in dollar terms, it's the first time we've had like a rally of more than 8 months in 17 years.
Yeah, yeah. I mean, it's the first time we've really seen international consistently acting well. I would say,
Yep.
going back to 2018 to, I would say, was it 17 to 18, I should say, sorry, 2017 to 18, really, we saw some good movement there. We hoped coming into 18, we'd see international kind of rally, and we just never really saw it. It almost
Yeah.
it looked like it was coming and then would kind of burn itself out. But we're seeing pretty good movement. And the European Union continues. Germany has kind of defied expectations. We talked about that a little bit on the last podcast, continues to post great numbers. And then you look at even like Japan and some of these other countries. And I think overall, from a growth standpoint, a lot of investors and a lot of the money has kind of flowed to some of the international stocks, which are up
Mhm.
nicely. I know Germany, I think if you look at a German ETF, some of those companies and stocks, everything's up, they're up about 20+%. Some of them.
Yeah, made big moves, and it's interesting. So now we keep talking about how our debt is at an existential level, 37 trillion, and it seems to be fine right now, right? And that's the way financial problems are. That's the way they work. They're fine until they're not, right? All of a sudden, one day things seize up, nobody will buy your debt, and then you got a problem. You got to restructure everything. So we haven't hit that yet, but at any point we could hit that, and that's really a big issue for America. So people are hedging. That's why they're buying gold, and that's why they're buying international stocks. Does this mean the international markets are now better and growing better than America and they're structured right? No, it doesn't. I mean, it's still not well organized. Europe markets have been socialistic for years, barely capitalistic, and so now they're finally coming out. Now there's some capitalistic leaders that have taken over some of the countries in Europe, so they're moving in a more capitalism direction. But does it mean that Europe has changed that much and they're not as bureaucratic and they have a capitalism engine like we do? Not quite, right? Still not quite there. But time will tell. Maybe they will take over the lead in the world, and we will set back a little bit. I don't know. I mean, I don't know how it's going to play out. But certainly, people are looking for something other than just U.S. stocks right now. They're buying gold and they're buying international stocks, and that's something to be thinking about.
Yeah, I mean, I think one of the I wouldn't say it's a benefit, but one thing we're seeing out of the European Union is the effect of the Russian-Ukraine war. Germany just passed a big bill to up their spending on defense. So, we're seeing more government spending, which isn't necessarily the best. Obviously, you want to see private spending, but you get where you see more government spending on the defense, on things like that, to
Mhm.
help boost that. So we're getting those injections, which I think could help boost, at least in the short term, some of the markets and economies there,
Yeah.
hot markets.
So, Chris, we started the year with a good month in January, and then things started to tail off. And then the Trump tariff thing happened, and the markets collapsed. And then we were down about 10% on the year. So now we come all the way back up. And, the first half was positive. Where are we now after like almost the first month of the second half?
So, are you talking about kind of general sector wise?
Yeah, let's look at sectors and I'll go through the indexes myself. So yeah, where are the who's in the lead? What
So,
sectors are doing the best and what sectors are doing worse?
so it's been a really interesting as far as sectors. I think most people would think just with the general CNBC and everything like that, you would think that, oh, it's tech stocks. Techs are, but you know, when you really look at it from a broader basis and spread it out, it's not as much so. So the number one position right now is actually industrials, which are up 15.29%. So, those we saw a little bit of a surge kind of towards we're about at mid to late July right now. They were in, I think, second or third position coming into July, but we saw a
Yeah.
nice surge there that pushed them back up to regain that number one position. So they are holding in the number one overall. Second right now is utilities. So utilities are up 13.19%. And once again, I think when you're looking at year to date, it's important to note as well that industrials, utilities, these did not drop as large as large as some of the other like tech did during kind of the end of February, coming into March and April. We still really started to see that injection of volatility, so they didn't have as much to recover from. So that helps certainly. I think that's
Hmm.
important to point out. But you have utilities running in that number two position, and then communication services is running in the number three position. It's up 12.04%. So
Hmm.
kind of an interesting mixture there, I would say in the top three, but it's really interesting. I think that you look at utilities, especially, you have the kind of a derivative play of the whole AI tech, as people they need to gobble up all this energy. And then I think they're getting a big boost right now because a lot of the country, and I'd say a lot of the world, is seeing a big heat wave right now, which is, I think, helping boost them in
Yes.
the short term as well. But
Well, let's,
conversely, if you flip to the worst performers,
yes. Where are
healthcare
they?
continues to be a major lag. And it's actually the only kind of sector that's still down year to
Go
date.
down.
It's down 0.62%.
Right.
So it still is, it's close, but it still is trying to get in the positive territory. Next up, we have consumer discretionary. That's up 1.05% year to date. So a little bit higher. We are into the ones at that point. And then the third worst performer, or in the number nine position, if you're looking at the S&P 500 sectors, that would be energy. It's up 1.75%. So energy has been really feast or famine. There's been times when it's spiked up to 5-6% up year to date, and then now obviously got pushed back down and is now sitting at 1.75%. So I think an interesting kind of scale there when you look at it. When you look at these broad asset classes, I think most people would think tech, and certainly communication services has a good amount of tech in it. But I think the key is technology, although it is a main driver within the S&P 500, which we'll talk about a little bit. When you look at the broad sector itself, it's kind of thin. Once you get through that first kind of tranche there, things start to weaken out pretty quickly.
Yeah. So looking at the general markets, Chris, the S&P is up 7.72, but it's up 2% since our last episode. And that's basically saying that, the tech stocks have moved a lot because they dominate the S&P. So techs have had a good run. Russell 2000, which is the small caps, were underwater at our last episode, not by much. They were under, negative just officially for the year. Now they're up about 1.8%. And the NASDAQ stocks, which is tech heavy NASDAQ, was up only 5.6. Now they're up 8.41 on the year. So that's had a good run this month. And then also the Dow was up only four. It's up 5.5%. So everything's had a pretty good run. Russell 1000 value up 6.56 as well. So the indexes are up. We're in a bull market. We're near highs. They're hitting new highs. But this is not a traditional bull market, is it? I mean, utilities don't they're not usually a bull market sector, are they?
No, usually utilities are leading or in the top three when we're having a recessionary year.
Recession or
Uh,
market panic. Yeah.
exactly. So
Right.
it is in a very untraditional market. I think once again, I think they're getting a little bit of a boost just with the derivative
Hmm.
play on AI and everything that's entailed there, as well as just the heat. We're seeing the heat wave right now, which tends to drive up
Hmm.
utility stocks in the short term.
Well, and then if the economy was really cranking, consumer spending would be strong, and we'd see consumer discretionary stocks up there, and that rate is ranked 10th out of 11th, right? So and we're not seeing that. Energy does whatever it does depending on what's going on in the market. So that's not necessarily a bull market sector, but financials and technology should be up there, and they're ranked fourth and fifth.
Mhm.
So we're not in a traditional bull market. We've been threatening to have a recession now for 2 years. It doesn't seem to want to come. And now with the Trump tariff maneuvers happening, a lot of new business is coming back to America. And that's probably why the industrials are running. But it's not affecting yet all the other groups, right? It's not affecting consumer spending and everything. So I'd call this a bull market, kind of a tepid bull market, right? And we're officially back on offense. It took a longer time than normal to go from maximum cash all the way to fully invested, but we finally got our signals there. But it doesn't seem to be yet the fully build out bull market, as we know. When 85% of the time the markets are going up in bull market fashion, that's not what we're seeing yet. Although it is a bull market, it's not the traditional bull market. So we'll see. Uh,
Yeah, it's a very top heavy market, I think, right now.
And then let's talk about concentration. You did some numbers on concentration, and that's a little shocking. Let's have a look.
Yeah, I mean, it's kind of delving deeper into that top heavy market. So the US stock concentration right now is really an all-time extreme, or very close to an all-time extreme. The S&P 500, for those of you who don't know, is not each stock, 500 stocks don't get the same amount of weighting. So they will, as stocks increase in price and kind of gain momentum, they will get higher weights within the S&P 500, and that conversely shrinks, obviously, the weighting of other stocks. So what that kind of looks at is most people correlate the S&P 500. It's more of kind of a momentum index, right? We have a lot of stocks a couple stocks are moving in the same direction. They're going to pull everyone along. Right now, the top 10 weights in the top 10 weights, so the top 10 stocks that have the highest weights in the S&P 500 account for 37.3% of the index. So just a little over a third, if you want to call it, are just 10 names. So that
10
makes
names.
10 names
That's
are a third, call it, and then 2/3 are the other 490 names, which is pretty crazy when you think about that. If we delve an extra layer beyond that, Nvidia, just one stock alone, Nvidia comprises 7.83% of the S&P 500, and that is the largest kind of weighting a single stock has had in the S&P 500 in the history of the index. It overtook Apple last year. Apple kind of took that
Mhm.
statistics, if you will. It was at 7.7%. So Nvidia just topped that. But when you delve a little deeper, so Nvidia comprises 7.83% of the
Mhm.
entire S&P 500 index. The entire consumer staples sector, so I think it's about 38 names, all those stocks comprise of just 5.4% of the S&P 500.
Mhm.
So one stock has a greater weighting than all 38 consumer staple stocks in the S&P
Mhm.
500 combined. We can go a step deeper. Energy is less than 3% weighting in the S&P 500. Utilities is another one, real estate and materials. All those are, I think, under 2%, essentially, 2.1%,
Mhm.
as far as composition. So you have probably a third of the names in the S&P 500 that are at levels comparable to a single name. So, what does this do and why should we care about it? Well, what happens is it puts the index, if everyone likes to compare everything to the S&P 500, it puts that index at peril to a degree, because now the fate of the index is really in the hands of one or two stocks. And if
Yeah.
Nvidia has bad earnings and tanks, and we get maybe a Nvidia and a Apple and a Google, for whatever reason, have bad earnings, you could get a huge pullback within the S&P 500. That's really kind of overstretched, if you will, just because their weighting is so high currently right now. So
Yeah.
it causes a lot of extra volatility potential within the index.
Yeah, those numbers are fascinating. And I remember in 1999, if anyone who was around back then, we had that tech boom from 97 to, that was the internet boom, the original one, 97 to 99, and it all fell apart. in 2000 to 2001. And so we're seeing that kind of even more concentration than than at that time. But so we've talked about this with investors, like, so if we're going to try and beat, everyone has to, they say you have to beat the S&P 500, right? So how do you beat the S&P 500? Well, you could buy an index fund and you'll do just as good or worse as the index minus whatever fees are in the index, right? So you're always underperforming a little. So then we try to outperform by overweighting these sectors that are doing well. Like we're overweighting, we have some utilities, we have some industrials, for overweighting the good sectors, right? Avoiding the bad ones. But if you just want to say, I want to keep pace with the market and you don't want to buy an index fund, we'd say take $100,000. That means, Chris, we would put $100,000, we'd put $38,000 into 10 stocks. Okay. And then we take the rest of the money, what's that, $62,000, and we put it in 490 stocks, right? Would we ever design a portfolio that way?
No, no,
No way.
no.
No way. And so folks buy portfolios usually in equal amounts. And then when they get to be a little larger amount, they'll shave it off. Or if it sells off and it's a loser, they'll sell it and get out. They don't take a big loss. But the point is people don't invest portfolios that way, right? But if we're going to continue to convince ourselves we have to beat the S&P 500, so we're good at what we do. It's really hard when the tech stocks are running and those 10 stocks are dominating the market. And how can you beat that benchmark? It's really hard to unless you have an index, right?
And I think we showed this, this is going back a couple of years, but after 2022, we, I think, highlighted the difference between 2021 and 2022, kind of the rise up and the pullback. And, when you get these concentrations, when you get stocks that are running like this, yes, they have incredible returns now, but when they come, say crashing back down, but when they have a pullback, it is going to be a severe pullback. So, a lot of investors can't handle that. I mean, if you have 8% of your portfolio in Nvidia and it has a 25% pullback just because it's at such extreme heights now, that's going to be a pretty significant hit to your overall. It's not diversified as much as it should be.
Yes. Well, and we saw the other side of this after the tech boom in the late 90s. And so many people had FOMO in the year 2000, thought they missed it out. They wanted to buy tech. And, we weren't sure it was going to end that quickly, but it did start to end right around then. And in reality, it had ended a long time before March of 2000 because the average stock stopped going up in April of 98, 2 years before the indexes started to crack. So we could see a market like that where other stocks are underperforming for a long period of time before the indexes start to crack. A little bit of that is going on right now. So we'll see if we have a full-on bull market and all the groups participate and the economy gets better, and that'd be a great thing. Or are we going to stay in this tepid area where we're not going to see great performance? The economy is going to be weak. Maybe we fall into a little bit of a recession. And then later on, the Trump tariff work helps, or maybe that's helping now. So there's a bunch of different scenarios that could play out. But, if you look at it, the possibility is that if people get crazy and buy all those tech stocks right now, you could lose a lot of your money. I remember some folks that bought some of these really hot internet funds in the late 90s or in mid 2000s thinking they missed everything. And some of those funds went down north of 70%. There was one very famous fund that went down 90%. So if people put money in that in the year 2000, they lost 90% of their money. So you have to be really, really careful if you get into concentrated areas like that. Let's hope that this market doesn't end up collapsing at some point like that. But when things run really, really hard like they are right now, they usually break pretty hard too. So you got to be very careful. If you buy the aggressive stocks that are really overextended, be ready with your sell ticket. Do not let it go down a lot. The folks that let Enron go all the way from $85 all the way to zero were praying and hoping all the way back up, and it didn't happen. So you got to have a discipline to get out. If something's breaking down, you may not know why. You may not know why the market's going down. All the other sellers know why, but you don't know that, right? So you got to have a limit. Maybe it's 10% or some sort of a trigger that you're not going to take any more pain if it starts going down. So this is a time of great opportunity. It's also a time of great challenges, right? That if people could make really bad mistakes if they do the wrong thing. So, Chris, you also had some other numbers, basically on Japan and trade, right? Give us some of those. Give us some of that.
I would say just as far as the general market, what we're seeing, Obviously the tariffs have a big impact on the market and kind of reactions to the market. Today it was announced the U.S. and Japan reached a trade deal. So Tokyo, or Japan in general, is going to face 15% reciprocal tariffs instead of the original 25%. So they scaled it back 10%. But under this deal, Japan will invest 550 billion in the U.S. It was kind of left more aloof how that's going to happen, but they said that over the next couple of years that they're going to make these investments in the U.S. probably for production for things like that. But it's a big driver right now in the markets. I know the car manufacturers in Japan got a big boost. Toyota, Honda. A lot of those manufacturers saw a big boost, and it's overall positive. The markets took that well. Anytime we get kind of a solidified tariff arrangement,
Mhm.
even though, yeah, now things might cost a little bit more and things like that, we are at least taking away some of that uncertainty, which we talked about, which the market does not like uncertainty.
Yeah. Well, and I think the markets kind of understands now that, maybe they were pushing it a little too hard in the beginning, saying, you got to cut your deal by a certain date, or we're not going to work with you anymore, and we're going to raise a big tariff. And then they kind of delayed that, and then they delayed it again. And now the market's kind of kicked in to realize, yeah, it's going to happen, but it's going to happen a little longer. So every other day on the TV, we see another country set of leaders sitting in the Oval Office with Trump as this country and that country. So they're cutting deals eventually. So the market kind of is figuring that out. And whatever the final numbers are on those deals, we're not really going to know. So it's hard for analysts to really say, "Hey, I'm dead certain that this company is going to have these earnings and those earnings and those earnings." But it's really hard to predict that now because you really don't know how the tariffs are going to be, how it's going to affect companies. But everyone right now is settled with the fact that things are generally going to be better, not worse, with the tariffs, except for certain industries that are, affected badly. But in general, it's going to be better. So that's why I think the market's reacting this way more positively.
Yep. Yeah. I mean, I think that, we haven't seen it actually get passed on to the consumer necessarily yet. We're starting to see inklings here and there.
Mhm.
But yeah, I mean, certainly some stocks, I know that the automobile sector, which has been reporting last week, a lot of them got hit pretty hard because, they do imports. So if you're, German car manufacturer, things like that, that post on the, American Stock Exchange, when they reported earnings, they reported a significant hit due to
Mhm.
tariffs, things like that. So we're starting to see some of it, especially for sectors, for companies that have a major part of their company, is international imports, things like that. But we really haven't seen the broad impact yet. And we've seen, like I said, tidbits here and there. We haven't seen a huge bottom line hit to like CPI, like that these costs are getting passed on to the general consumer yet. Once again, I think there still is that looming uncertainty. But each month we continue to get relatively soft CPI numbers. We're not
Mhm.
seeing a big spike yet.
Well, let's talk about the economy in a minute. But Chris, I wanted to mention that if anybody remembers a couple of years ago, this young analyst sitting in his basement in Massachusetts, roaring kitty, and all the things that were going on with GameStop. I don't know how many people out there traded GameStop, but here was a retailer that was functionally bankrupt in some ways, but it became a meme stock, and everybody started buying it. It went up 300 and 400%. And Roaring Kitty was controlling the whole thing, and there were all these people watching Roaring Kitty. Well, we now have, you guys remember that? Remember Roaring Kitty? Okay, we have a crew here with us today that are watching the taping, and so now we got the return of the meme stocks. Chris, give us a couple of meme stocks. What's going on?
Yeah, yeah, we've seen recently in the last month or so, we've seen a return of meme stocks again. And the even though it's the same, this at least so far seems to be a little bit more volatile. Kohl's is the kind of one of the more recent ones we saw. So just last week, so 1 week ago, it was trading at $9. Now it's trading at about $14. So just a 38% pop in the stock price. For no reason, just because people piled into it. The companies that are being targeted, just like GameStop, are heavily shorted. So you have a
Sure.
lot of hedge funds, a lot of institutional owners that have sold short. They didn't own the stock, they sold it short, so they have to buy it back to get out of their position. So what's known as a short squeeze is when you pop that, bring the price up really fast in a really quick amount of time. All those people have to go and cover, so then they have to buy. So then you just get this big buying pressure that moves the price of the stock very quickly. So
Yeah, and they call that short covering or a short squeeze,
a
right?
short
Where
squeeze.
the guys that are short, every time the stock goes up a little bit, they start losing money. It's infinite how much money they could lose. So
Yep.
then they're in a panic to buy. All of a sudden, boom, the stock explodes upward. That's what went on with GameStop. Looks like it. That's what's going on with Kohl's, and
Well,
Kohl's is struggling,
yep, Kohl's is
right?
struggling. I'd say the biggest one right now is Open Door Technologies.
Mhm.
So they were trading at just 53 cents and for a penny stock, pretty much under a buck.
Mhm.
At the end of June, 53 cents. It shot all the way up to $3.21 in almost 3 weeks, which is about a 439% return. So crazy numbers there. GoPro, I mean, everyone knows GoPro
Yeah.
for cameras. That is up nearly 277%. It was up 50% today. It's since pulled back a little bit. Krispy Kreme is up 13%, and 1-800-Flowers is another one up 14. Those are recent movers. So it's a little bit more diversified. I think it was like GameStop and AMC were kind of the big ones that kind of got some attention. Now we're seeing it spread out a little bit more. But
Yeah.
one thing that's important to note with this one, I mean, any of these things, it's like the lottery, right? You're dealing with fire here. So, but this more traditionally looks like a kind of I would call it a pump and dump, right? They're
Mhm.
pumping the stock up extremely fast, and then within the matter of a couple days, just dropping it. I saw Kohl's was down 20%, I think today. Open Doors down about 20%. GoPro was up at one point 50% today. On a single day, just today is already down to about 20, only up 20%. So we're seeing a lot of these movements, and you know, you're going to get a lot of people probably that are going to try to buy this thinking that they're going to be on, the next millionaire. They're going to make all this money off of it.
Mhm.
They're going to buy on that way up and just
Mhm.
get the rug pulled out from underneath them, essentially.
And everybody, it's like a mania. Everybody jumps in, and as long as this is all legal, as long as they follow the securities laws, and the short sales have to cover their shorts, and the buyers can't necessarily collude, but they can all talk and they can do different things. So as long as they follow the rules, this is all legal. So
Yep.
we'll
Yeah. I
see.
mean,
We'll see if any more struggling stocks get rescued by the meme players.
yeah, the list of stocks that have large short positions in them is public. It's publicly available
Mhm.
knowledge. So anyone can use that. You just have to get enough people and momentum behind it. So it'll be
Well,
interesting to see how it plays out.
and I noticed that all these stocks are below $10, and we used to always say the stocks that are below $5 are there for a reason. It's usually not a good one. And I'll add up to stocks below $10, and because Kohl's was at 9, the rest of them were under $5, right? So if a stock's
Yep.
really doing well, it may be public, it may be trading, it may not be trading very much, but if it's at that lower level, it could be on the way out for that matter. And there are literally hundreds and hundreds of small cap stocks that are in the market. They trade in what we used to call the pink sheets, which is the lower level of NASDAQ, and they barely have any volume, but they're technically still public. And that's where we'll see all those meme stocks probably launch from that pink sheets.
Yep. Yeah. I mean, it's businesses that have, I don't say tradition, they're kind of traditionally dead for the lack of a better term. I mean, you look at GameStop, a lot of people purchase their video games or movies online. You have Netflix now. You can just do it digitally. So, look at 1-800-Flowers. I mean, their name is still off of a phone number when most people would
Yeah,
probably just order their flowers off the internet. I know you can still do that with that, but it just shows that a lot of these, they're kind of companies that have almost been through their life cycle, if you will.
yeah. Well, they've got great commercials, 1-800-Flowers, so you never know, right? Um,
Especially around Valentine's Day.
so, all right, Chris, let's switch to the economy. So, do we have positive things and negative things happen all at once? Let's hear the numbers
Yeah.
there too.
Yeah, and interestingly, I mean, for the most part, we actually saw some positive economic indicators. The first one, the leading economic index or LEI, that declined 0.3% to 98.8 in June. So it declined a little bit more than expectations. The expectations were 0.2% expected by economists, but still right there. I think right now, they're looking, what this kind of is supposed to impose is, all right, are we heading into a recession? What are the indicators kind of showing us as a combined number? So, We'll see though. But that's kind of the first dour one, if you will. The producers price index, though, that was flat in June. And that was following an upwardly revised 0.3% increase in May. So the May number got moved up a little bit higher, but the June number was flat. And year over year, the PPI is only up 2.3%. Why do we look at the producers price index? That's a good indicator as far as what inflation is going to be doing.
Right.
Because if producers are having to pay more for their inventory, for their goods or raw materials, they're usually going to pass that on at some point to the general consumer. So that's why we like to look at that. And it's actually pretty positive that it still has remained relatively muted. Going down to the next level is the CPI. So this is the consumer price index. This is what the consumer is paying. It rose 2.7% year over year in June. That's up slightly from the 2.4% reading in May, but that was right in line with expectations. The core CPI, which excludes food and energy, which tend to be a little more volatile, that rose 2.9%, and that was also in line with expectations. So for the most part, inflation-wise, things are kind of panning out, I guess, how people expected, but we are starting to see it rise. I think that's
Right.
important to point out. We're not seeing a drastic jump, but it is kind of ever so slightly moving up from an
Right.
inflation perspective. Jumping over to kind of the manufacturing area, the New York Fed Manufacturing Index rose 5.5% in June, which was a huge beat. The expectations were actually a decline of 9%, and obviously it grew by 5.5%. So that was overall really positive to see. U.S. industrial production as a whole rose 0.3% month over month, and that beat expectations of a 0.1% rise. So, overall, from an industrial and manufacturing standpoint, it seems like the U.S. is actually still holding pretty well, holding the ground. A lot of people expected a massive drop there with the tariffs. You haven't really seen that yet. And you saw the expectations being negative 9% and having an actual growth of 5.5%, I think shows the drastic of expectations and actually what's happening. The Philly Fed Business Index, so this is kind of the general business climate within the Philly area, came in at 15.9, and that the expectations were actually a -1 reading there. So that's a big beat as well. Once again, you have the expectations now. You can see a slowing economy, slowing market, but kind of the actuality of it, it's kind of proving that there still is a little bit of life there, if you will. We're still
Right.
seeing that growth, even though expectations continue to be lower, dour, and negative. So it's really interesting. I think that the anticipation is that we're in a recession, or we're moving towards a recession. But we've had that anticipation now really since March, April, that we're
Yeah.
we're going to see this big recession. Oh, everything's over, and we
Mhm.
just really haven't seen it come through. It's kind of let's see what next month brings, and the numbers haven't really been there yet. So, we'll
It's
keep
like
an eye
the
out.
economy that won't die. The economy that
Exactly. I think
won't
it's
die. Yeah.
defied a lot of people.
Yeah.
Um, so kind of going a couple layers down, retail sales recovered in June.
Yeah.
So they saw a increase of 0.6%, which beat expectations of only a 0.1% rise.
Mhm.
And more importantly, that was a solid rebound. So in May, it posted a negative 0.9%. So we saw a nice rebound in retail sales. So it seems like consumer spending kind of rebounded.
Mhm.
That's positive. I think overall, it shows that the consumers may be getting a little more comfortable now, settling into things a little bit, especially with the tariffs. Maybe that some of that fear was coming down. Positive to see overall. Using U.S. housing starts, we're roughly in line, coming out 1.3 million in June. I know some of the home builders had pretty nice beats so far this week, so that's been overall from a building perspective positive. But on the flip side of that, kind of the existing home sales, as far as current homes, they decreased 2.7% in June, and that ends up in a 10-month low now as far as home sales. So the volume of home sales occurring. And when you see that volume decrease, uh, usually that means less volume, there's less transactions, a higher price, kind of usually how that goes. So
Mhm.
we did see that the national median existing home price in June for the broad United States was $435,000. which is a new record. And this is going back to 1999, I think, was when they kind of started
Or
tracking this.
tracking that, yeah.
And that's up at 2% from a year earlier. So, really shows the housing market. Really, we haven't seen that relent yet, which I think is extremely surprising. I mean, you still have a 30-year mortgage is still called 6.8% roughly. You still have pretty high interest rates for these. We're not seeing these come down drastically. I think the fear to a degree potentially is if you do lower rates, are we going to see this market heat up even more? Because if you dropped the interest rates 30-year and that came, let's say at 4% or call it 3.5%, you cut that in half, what would that do to prices? I think it's going to be really interesting to see. The housing market, I think, as a whole um, is really going to be really important, I think, in the next coming years. I think there's a lot of issues there. There's a lot of building going on. Hopefully that kind of continues.
Mhm.
But there still is not nearly enough supply to meet the demand.
So there's still about 6 million housing units that need to be built. But there's still a lot of restrictions in California. They're coming up with some new ways to add more units to the same property, like in-law apartments and other units that built into the same building. So instead of just single family home, you could have a unit above your garage. You could have another unit off to the side. And so they're building new ways of building housing units in California because they still don't want to build on any more land. So that's really a big part of the land constraint. And then, we have housing sales decline, but prices go up. That's pretty curious, isn't it? Right? That means not much is going on. President Trump is blaming the Fed chairman and the Fed for keeping interest rates too high. Of course, they're having a battle. Everybody has seen that every other day. There's some words between the Fed and the president. But, that's he's blaming them for young folks not being able to buy a home and the medium home price is going up. But of course, that's not what the new home buyer would buy. They'd probably buy a smaller townhome or a smaller apartment or something like that. But unless you're in certain states like California where everything's north of 400,000, there are things cheaper than that. But still, it's a very tight real estate market. Not much going on. The mortgage market is difficult as well. So those are curious things. Usually, when the economy is strong or getting better, we see housing do well also. So we're not.
Yeah.
Yeah.
No, I mean, you think about it. I mean, to you have to have people that are willing to pay this price at a pretty steep interest rate. So, that would show that there's
Mhm.
enough people out there that are still willing to pay that, that are still able to pay that. There's enough people that are employed that are making enough money to do that. So, yeah, I mean, it's really interesting. I mean, I think that it'll be interesting, I'd say 20 years from now, looking back at this and probably people are going to be studying this time period.
Well, and markets will break where they're going to break, and the reality is that we like to think we know how they're going to break, but we really don't, right? So we're seeing plenty of green lights, plenty of red lights. Gold is up 1% in the last month, and it's up 29% for the year. So why is gold up so much? Because gold sat there for a decade, really not doing much, and it was Bitcoin that took all the excitement. Right now, Bitcoin is stabilizing up in the 100,000 range, somewhere up there that had a big move. Now it's not moving up as much anymore. And then gold and silver are moving. And that's the other one. Silver had been a laggard this year. And then in June, it was up 9.4%, Chris. Then in the last month, again, it's up another 8.27%. And it's up 35% for the year. So now silver is leading gold for the year. So why are precious metals going up? Well, people are still a little nervous, right, about the economy. Maybe some people are nervous about the dollar. The dollar is getting weaker, so the international stocks are getting stronger. So then the dollar will be weak, then it'll be strong. So again, we're getting kind of mixed signals there. But certainly gold is where people think that they certainly have plenty of commercials on TV telling them they should buy gold when the economy is bad. And there's some truth to that for sure. But then for a while, Bitcoin was the new gold, and now gold is the new gold again. And maybe Bitcoin will take up some of the action again. So it seems like they're kind of working in concert to the kind of the anti-dollar in a sense, if you will.
Yeah.
So,
Well, I mean, I think, you talked about it, touched on in the beginning, Brian. I think that we have this national debt that just continues to grow. And I mean, it is almost to the point where it is going to be impossible to really reverse it. I mean, never say never, but it is going to be extremely difficult to reverse it and to kind of claw things back. And so, the only way to do that would be to kind of print your way out of it. It's deflationary. So, we're seeing that dollar, the impact weaken there. A lot of people are saying, I'd rather just, instead of keeping my money in the dollars, I'll take half of it and put it in gold. At least then the value is stored there a little bit more securely.
Yeah, no doubt. Well, all right. Well, we've got a couple other things here. The CBO is saying the big, beautiful bill that was passed recently will add trillions to the deficits, but they don't calculate anything to do with tariffs and the positives that'll come out of the tariffs and all the business. There's an estimated almost 15 trillion worth of new investments that have been announced in America, and that is big. So there's a big difference in scoring. President Trump might be right on this one. We're bringing a lot of business back to our country, stuff that we've given away years ago, all the manufacturing that went over to Asia. And the wages of manufacturing labor have not gone up in recent decades. So that could all change again. So we're in new territory. Again, we're not sure how things are going to shake out. But President Trump is taking some risks for the country to turn things around in certain areas and using tariffs to do it. And, people wonder, is this kind of a weird thing that he's just doing it now? Well, if you look at all the stories in history, even before President Trump was even considering to be a candidate, he'd go on the Oprah show and talk about tariffs and things like that. So he was always a tariff guy. He thought that we were letting our industries be invaded by countries outside of America, and we did that. And it helped certain businesses, but it didn't help the labor markets for sure. So that's all hopefully going to change. Does look like, though, because the chairman of the Fed is concerned about what the tariffs will do, could be inflationary. So they're keeping rates high. There's a chance now we may not see even a rate decrease this year. So we'll see.
Yep. Yeah, I mean, I think it keeps getting pushed out. I think right now the September rate's getting pretty priced almost that's not going to be there as we get closer, obviously. And then you got November and December. I think they're still saying 2 cuts this year. But surely as we get, each month, if this continues to hold, it gets less and less likely.
Yes. Well, okay, Chris, I think we're coming to the end here. Just so as folks listen to all the things we said in the show and all the positive and the negative things, we're seeing enough positive in the financial markets that we're now back in. And as we said before, that 85% of the time the markets are going up in kind of normal fashion. And most folks are making money. Average markets average about 10% a year in the stock market. So generally, people are having a positive experience. We're having a positive experience again after a very tough couple months there in the middle of this year already. But we're not really convinced that it's going to be a huge rally. It could be just a short rally, but whatever reason, it does appear like it's going higher. So we're fully invested. 15% of the time, we're in correction phase or outright crash or panic in the markets, and that's when we take protection. But we've now taken our protection off. We're betting on the upside. We're taking risk, and we think that's right now the right posture to be in. But you always got to watch it very closely. And I think that's all I have, Chris. And our listeners know that the Leadership Matrix, which is on FourStarWealth.com, you can get there right by going on to our website and click on the Leadership Matrix, and you can see all the different postings that are going on. We put out a really interesting article about pets. Pets are becoming more and more attractive to have them in your house, more and more building, home units without many people, maybe one person alone. You have pets. All kinds of people love pets now. It's a huge, huge business. So we had an article about how people love their pets, what they're spending on pets, and what it means to the economy. The pet business is big, people. It's booming. So go on if you want to read a little bit more about it. We have some good articles about the pet business. Chris, what else do we have?
I think that about covers it for the kind of mid to late July.
All right. Well, great. So here we are ending July. Everybody have a good August. We'll be back in a couple weeks with another episode. We're going to do some interviews this summer as well as we all kind of hit the beach and take it easy. You'll hear some interview episodes also. But Chris will leave it there. Thanks everybody for being with us again on today's Market Explained. And over and out for today. Thanks everybody. Bye-bye.